NVIDIA, $1 trillion. Gone. 60 days. OpenAI, can't go public. Burning $5 billion a year. Apple, 33%, price hike. Blamed AI, 142,000 tech workers. Fired. AI cited as the reason. 5 signals. Nobody is connecting them. Individually, each has a reasonable explanation. Together, they form a pattern identical to one we've seen before, and signal 5 is the one that makes the whole picture click. The dot-com boom didn't end with one crash. It ended with a sequence of signals that individually seemed manageable until the pattern became undeniable. By signal 4, you'll understand why companies are making decisions that look insane. By signal 5, you'll see why this correction might be structurally different from anything tech has experienced. Signal 1. NVIDIA hit 235 on May 14th. 6 weeks later, 192. 18% decline. $1 trillion in market cap erased. But the company is still posting record revenue. Earnings still accelerating. What changed? The multiple compressed. Forward P/E went from the low 30s to around 20. The market decided the AI growth premium was too generous. Same company, same fundamentals, lower confidence in the story. Wall Street's word for what happened? Orderly. The bubble already burst. Nobody noticed because it deflated quietly rather than popping dramatically. The Nasdaq dropped 4% in a single session. The entire semiconductor sector shed $1.3 trillion. This wasn't one company correcting. This was the market repricing AI infrastructure as an asset class. And that repricing connects directly to Signal 2, because the poster child of AI can't even go public. 180 million users, 3.6 billion revenue, still can't go public. OpenAI burns $5 billion per year on compute. It carries $665 billion in off-balance sheet procurement commitments, contracts for future compute that dwarf its $73 billion cash reserves. The IPO is delayed to 2027 because Sam Altman won't accept below $1 trillion valuation. This was supposed to be the defining IPO of the AI era, the one that proved the model works at scale. Piper Sandler's technology investment banking co-head said it directly. We need OpenAI to go public so other software IPOs can come to market. The entire tech IPO pipeline is frozen. Not because companies aren't ready, because the market needs the AI leader to prove returns first. And while waiting, OpenAI started testing ads inside ChatGPT and e-commerce partnerships with Shopify, the most funded AI company in history, the one building artificial general intelligence. Testing display ads to survive. That tells you everything about the economics of intelligence in 2026. But Signal 3 is what makes this genuinely alarming. The AI boom isn't just failing to generate returns. It's actively raising costs for everyone else. June 25th. Apple raised prices on 14 products. Mac Studio, $3,999 to $5,299. 33%. Apple's official explanation: ongoing memory chip shortage caused by companies building AI data centers. Apple said the quiet part loud. $700 billion in hyperscaler capital expenditure this year is consuming global chip supply. AI is making everything more expensive for companies that aren't even AI companies. That $700 billion doesn't produce returns immediately. It produces data centers that need workloads that generate revenue. And right now, the workloads aren't generating enough. $400 billion annually in spending. Limited enterprise monetization. If applications don't deliver ROI in the next 18 months, those data centers become the most expensive stranded assets in technology history. Which brings us to Signal 4, and this is where it gets uncomfortable. 142,000 tech jobs eliminated in 5 months. At that pace, 370,000 by year-end. Oracle, 21,000 cut, 13% of its workforce. Meta, 15,800 positions as part of a $135 billion AI plan. GitLab, 14% of staff to fund AI infrastructure. Cisco, 4,000. For the first time, AI is the most cited reason for layoffs across every industry. Not just tech, every industry. According to Challenger Gray and Christmas, AI passed restructuring as the primary layoff justification in May. Now the uncomfortable part. According to Gartner, April 2026 data, only 28% of enterprise AI meets ROI expectations. 72% fails to break even. 20% fails outright. 62% of CFOs say fewer than a quarter of AI initiatives deliver measurable benefits. Let me say that clearly. Companies are firing proven human workers to fund AI systems that fail 72% of the time, cutting what works to bet on what mostly doesn't. Not because the data supports it, because the narrative demands it, because the board demands it, because the market punishes you for not having an AI strategy, even when that strategy burns cash. That's the moment in every cycle where story disconnects from reality. And Signal 5 shows exactly how extreme that disconnection has become. U.S. venture capital hit a record in 2026. The headline says boom. The distribution says crisis. $188 billion flowed into AI mega rounds. Meanwhile, emerging fund managers saw fundraising fall 35%. First-time fund formation, worst year since 2016. The venture ecosystem isn't booming. It's being distorted by extreme concentration toward 2 or 3 companies. This is the exact pattern from 1999. Maximum capital concentration into a single infrastructure thesis, immediately before the repricing. Then it was internet infrastructure. Now it's AI infrastructure. Same concentration, same divergence between spending and returns. Gartner placed AI in the trough of disillusionment for all of 2026. 50% of generative AI projects abandoned after proof of concept. The narrative is still holding. But underneath, the data is deteriorating, signal by signal. 5 signals. NVIDIA's trillion-dollar repricing. OpenAI's inability to go public. Apple admitting AI raises costs for everyone. 142,000 fired to fund systems that mostly fail. And record VC flowing to 2 companies while the ecosystem starves. This is not the end of AI. The technology works. But the financial structure built on top, the valuations, the spend rates, the capital allocation, that structure is correcting. Quietly, orderly. Exactly the way the last bubble corrected before anyone called it what it was. The companies that survive will be the ones with revenue today, not promises. Today, the market is no longer willing to wait. Subscribe if you think with data, not narratives. And tell me in the comments, healthy correction or the start of something worse?